If you have ever delved into cryptocurrencies, you have probably come across centralized crypto exchanges. In recent years, these exchanges have played a significant role in the proliferation and acceptance of cryptocurrencies in society. However, they also have some drawbacks, such as the risk of data breaches and hacks. Decentralized exchanges based on blockchain technology are an alternative to these centralized exchanges. In this video, we will explain how a DEX works and the advantages and disadvantages it has compared to traditional systems. Stay tuned and let's take a journey together into the universe of USDFI. What is a decentralized exchange or DEX? A DEX is a cryptocurrency exchange built on a decentralized platform. Unlike exchanges operated by a central entity, a DEX is managed by a protocol on the blockchain. This technology allows users to trade cryptocurrencies directly from their own wallets without having to trust a specific person or institution. Your wallet is not linked to personal data and you retain full control over your private key. However, there are some disadvantages of a DEX, such as a lower liquidity and trading volume, as well as more complex user interfaces. As mentioned in the video introduction of USDFI, the user experience will be simplified by providing a unified layout for all functions. However, there is still the problem with liquidity. For example, to exchange BTC for USDFI in both directions, both USDFI and BTC must be deposited in the protocol. The program that manages these assets is called the liquidity pool, or LP. By depositing into an LP, you provide a portion of the pool's liquidity and receive a receipt called liquidity pool token. As experienced users among you may already know, it has often been the case that you need to have both assets at the same value in dollars to deposit them into the LP. For example, $50 in Bitcoin and $50 in USDFI. With USDFI, that has been further developed so that you can also invest $100 in Bitcoin and the protocol splits it evenly in the background into the new two assets of the LP. At USDFI, stable tokens are distributed proportionally to all holders of these LP tokens daily. So, if you have deposited into an LP, you will also receive stable as yield from it. Just like with a centralized exchange, traders are charged fees for exchanging one asset for another. These fees are invested 80% in the Universal Banking Protocol. In the voting video, we will take a look at the remaining 20%. The keyword here is bribing. By reallocating money to the UBP, more and more liquidity is also brought into these LPs and made available on the DEX. This makes the protocol and platform more independent of other investors' capital. This is a very important aspect, as platforms have often been at risk of collapsing when many users withdraw their capital at once. One important thing that has been discussed in the DeFi space from the beginning is the concept of impermanent loss. Most people have probably heard of it, but let me give you a brief summary. The problem with impermanent loss is that the prices of the cryptocurrencies held in the pool fluctuate against each other. If the price of Bitcoin changes compared to USDFI, the liquidity in the pool shifts in favor of the cheaper asset. If the price of Bitcoin rises, Bitcoin must be automatically sold to get the same dollar value as USDFI. If you withdraw your shares from the pool at this point, you may receive less BTC than you deposited. This loss is only temporary as long as you're in the pool and is therefore referred to as an impermanent loss, as the shares of cryptocurrency in the pool continuously adjust to price fluctuations. That's all from me today. Stay tuned for the next USDFI video. Best regards, Benjamin.